Bismillahirrahmanirrahim. This is me, Hira Fayaz, Senior Officer Members, Professional Development, ICMA Head Office, Karachi. I welcome you all to this webinar on KSA Zakat and Corporate Income Tax System. Let's start with the recitation of Holy Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين الرحمن الرحيم مالك يوم الدين إياك نعبد وإياك نستعين اهدنا الصراط المستقيم صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين
آمين.
Jazakallah. Now I would like to call our host of the session, Sayyid Faisal Zaidi, Member KSA Branch Council. Over to you, sir.
Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh, and very good evening to everyone. I welcome you all to the our series of tax webinar, and this is KSA Zakat and Income Tax webinar. As you are all aware that KSA tax system has been continuously evolving, and regulator very much emphasis on the compliance of tax. Definitely warrant the finance professional to keep their pace up and keep their knowledge up to date all the time. Fortunately, we have some esteemed members with us who are very recognized in these fields, which includes the Siraj Ansari himself, who's also the KSA branch council chairman. With us we have Abdul Hafiz and Noman Ismail Saab. These professionals are very much cognizant and recognized in their fields, in the field of income tax. They will shed some lights on our recent update, as well as some. They will also discuss your problems when you ask. And I hope that this webinar will bring you a lot of updates, and you will go out after learning some very insightful information out of it. So I like to invite Mr. Adil to start the presentation. And going forward, then Mr. Noman would be chip in, and Siraj Ansari Saab. Thank you, everyone, for attending, and over to you, Adil Saab.
Assalamu alaikum. My name is Mohammad Adil Muiz. I'm an ICMA member, and I'm working in finance and taxation for around last 17 to 18 years. For the last around 10 years, I'm working in KSA and looking after the tax and zakat of Bin Daud Holding Group. And secondly, I would like to thanks this KSA Branch Council and the ICMA CPD committee for providing me the opportunity to have a presentation on this very important topic, because you know that KSA tax and zakat, the compliance, it has got very much progressed and also quite complicated. So its compliance and other things are very important for the businesses. Otherwise, they are at quite a high risk. So this in this first webinar, we are focusing on the zakat and corporate income tax of phases of this our KSA taxation system. So if I can start the presentation. So
Yes, we can see your screen, Adil.
Okay, okay. So the timing of this presentation is also very crucial because you know that we nearly all are in the process of filing our zakat, and who are subject to corporate income tax, they are filing the CIT returns because the deadline for the 99% around entities which have their financial year ending at December 31st. The deadline is 30th April. So it is quite near time that we are filing. So this seminar will, I believe, be hopeful that for those managing the tax and zakat function, it will be helpful for them for compliance purpose, and for getting any ambiguities removed, and also for our new ICMA members and students. It will be a good platform to get the basic understanding of the tax and zakat system of KSA. So this. Okay. So, yes, the KSA tax this framework, I would like to uh, first mention that of little bit historical perspective, that this is KSA, this tax and zakat has a quite old history, and the zakat and corporate tax was implemented in early 1950s. So by law, it was introduced there. And in this connection, we can say that Saudi from other GCC countries was quite lead runner in this condition, because we see that for UAE and Bahrain, other GCC countries, their corporate tax reforms and other things are quite late. But here in Saudi, this corporate tax, withholding tax, and other things, they are quite old. Here in Saudi Arabia, this tax and zakat system is quite it is mature, old, and it's a developed system. So in early 1950s, this zakat and corporate system was laws, and this were through ministerial resolutions and other orders, they were implemented. And we see that they were gradually these systems were augmented, and there was gradual progress. The regulatory framework, it was made, the institution zakat for zakat and taxation, is it was made, and these gradually laws and regulations were implemented. However, for the last 10 years, we have seen that there is a massive the tax framework, the tax environment has greatly revolutionized, because in amid the progress was very gradual. But in the last 10 years, under the Saudi Vision 2030, we have seen that new taxes were introduced, like excise tax, VAT, and new frameworks like transfer pricing, e-invoicing. They were introduced to the one of the main object was to boost the non-oil revenues, and also to compete with the international market, to compete with the best international practices. So for last 10 years have been this zakat and tax system has really, it has you can say move in leaps and bounds. And the tax compliance, from an organizational perspective, it is very important, crucial. And when we see from our individual perspective, it is also very important, because now your understanding about the tax and zakat should be very good, should be up to date to actually thrive and survive in this competitive market. So the regulatory authority who is governing the tax and zakat in Saudi Arabia is ZCA, the Zakat Tax and Custom Authority. It is the authority which it administers all the tax and zakat, and it is responsible for all the the collection of taxes and the laws and regulation and all the administrative setup which governs the tax and zakat mechanism. So this ZCA, it is the basically the tax authority which is which do this function, and it is based in Riyadh. The head office is based in Riyadh, but they have regional headquarters in other cities also. So this ZCA is also a very, it is a robust and dynamic tax authority, and it is providing services and also taking this zakat and tax compliance in a very professional manner. And they not only for they have provide mechanism for collection and regulation of the tax, new regulation and laws, but also they have provided digital platforms for this compliance and reporting. So we have got the ZCA portal, we have got the Fatura portal. So all things they have now, by the passage of time, they are digitized and automated, and now you don't have to file manual returns. Thing we these all the returns, all the tax submission, all the zakat submission are now online. So this is a big this move forward by the tax authority. And previously this the zakat and tax, there was separate authority, general authority of zakat and tax, and for customs there was another authority, GCA, the customs authority, general custom authority. But in, I believe, in 2021, these they both were merged, and this ZCA was formed. And so it is looking after all the tax matters, one authority under, you can say, under one window. They are looking after all the tax and zakat matters, and the customs and custom duties, that those are relating to imports, everything. There's one authority who is looking after. Now, another important aspect of this the system in Saudi Arabia, that it is a dual fiscal system. Here in Saudi Arabia, you have both zakat and corporate income tax. Unlike other countries, in other countries, normally we have corporate tax. We have in corporate income tax, but in Saudi Arabia, there are two categories of this two of this fiscal system. That one is zakat, and other is corporate income tax. Zakat is basically applicable to Saudi and GCC national owned entities. So those entities which are owned by Saudis or GCC national, those entities are subject to zakat. They are not subject to corporate income tax. They are only subject to zakat. Whereas those entities, foreign owned entities, which don't have shareholdings of Saudi and GCC, they are subject to corporate income tax. So this is basically the breakdown, and there are some mixed entities also that have some shareholding of the Saudi GCC and also the foreign holding. So they are complied for both zakat and corporate tax. So there are this either entity will be 100% Saudi, that will be filing only for zakat, or either 100% foreign owned, that will be filing corporate income tax, or otherwise there are mixed entities which will be filing both zakat and corporate income tax. Regarding the tax environment, I would like to discuss about the major components of the tax environment, which has over the past where this environment and these components have quite augmented, quite increased. So above first thing is zakat, that it is, that zakat it is a religious levy as per our religion. It is the third pillar of Islam. So zakat is a religious levy which is levied on the Saudi and GCC owned entities, and we have to and it is 2.5% on the zakat base for the Hijri year. So this zakat is a very big mechanism. Yearly, we have to file the zakat returns, and the detail we will discuss later. So, zakat is a major pillar of this Saudi, you can say, tax and zakat environment. And then there is corporate income tax, which is on the taxable profit of non-Saudi and non-GCC foreign shareholdings. So it is, and the rate of corporate income tax is 20%. The general rate is 20%, whereas for some sectors the rate is high, for hydrocarbon related sector, but the general uh, tax rate is 20%, corporate income tax. And this corporate income tax is also filed on a yearly basis. And the third major important thing is withholding tax. It is because also related to corporate tax. So withholding tax, basically it is the tax we deduct at source on the payments which we made to non-resident parties. We, yeah, foreign parties which are non-resident parties, the payments when we made to these non-resident parties, so some of these payments are subject to withholding tax, and depending upon the nature of the payments, nature of the services, and the withholding tax rate they range from 5% to 20%. So this is withholding tax is also a very important component of the corporate tax system, because it compliance is very important. And withholding tax return is filed on monthly basis, and it has also there are very you need to be very compliant with all the laws and regulations. Then we have got the value added tax, VAT. So VAT, it was introduced in Saudi in 2018, and it is the major indirect tax of Saudi Arabia. First, it was introduced at a 5% rate. 5% VAT was introduced, but then after, I believe, 3 years or 2 or 3 years, the rate was increased to 15%. So now the tax VAT rate is 15%. And this VAT, it is charged at all stages of the supply chain, from the producers till the end consumers. So at each stage, this 15% is charged, and this the final the main thing is that the final burden of this VAT is borne by the final consumers. And for VAT is on the supplies of goods and services which have their place of supply in Saudi Arabia. And it is VAT, it is charged at the standard rate is 15%, but there are some goods and the goods or services which are the charge is 0% also. There like medicine and medical equipment, there's nowhere they are at a 0% VAT. Similarly, some services and or goods or services categories, some supplies, I could say, they are exempt also, like residential rentals. So residential rentals, they are this accommodation rentals, they are exempt from VAT. And also like financial charges are also exempt. So these are the three broad categories: 15% the standard rate, then 0%, and also exempt. So 0% exempt, we know what is the difference, that 0% are supplies are also taxable supplies at 0% rate, and we can deduct input tax against those supplies, which is related to the zero rated supplies. But for the exempt supplies, we they are not taxable supplies. They are exempt supplies. So the input tax, that input tax against those supplies, it is not admissible. We cannot claim that input tax. So that is the basic difference. So this VAT is it's a major indirect tax, and I believe it is a major contributor to the this national taxation revenues, because a very big part of the taxation revenue is come from this value added tax. Then we have excise tax. Excise tax, basically it was implemented in 2017 in Saudi Arabia, and its basic purpose was it is imposed on harmful goods. It is meant on those goods which were harmful for personal health, and it was imposed, like sweet drinks, carbonated drinks, energy drinks, and also tobacco products, that later they come into exhaustive also. So these things which are basically injurious to health, so what the government aimed, that they put high taxes on them from 50% to 100% to make these goods very expensive. So when they get very expensive, then their consumption is automatically very much either abolished or curtailed. So this was the main objective. So their rate is from 50% to even 100% for like energy drinks and tobaccos and these smoking devices. It is 100% excise tax on them. And excise tax just recently, for from this year, they have in excise tax a major change is done, that for the sweetened drinks, they have put a volumetric basis for imposing of excise tax. Previously, it was 15%, but now on the volume basis, for only for the sweetened beverages, they have put excise tax. That if some sweet drinks, they are very low content sugar, it is exempt from excise tax. No excise tax imposed, and gradually there are some slabs are there, and accordingly, as the sugar content increase, the excise tax also increase on those items. So this is about excise tax, also important part of the taxation environment. And then there is a real estate transaction tax, RAT. So RAT, it was introduced, I believe, in 2024 in Saudi Arabia. So the basic reason, uh, it is the RAT, it is imposed on the supplies, on the transfers of real estate property, the real estate property, houses, buildings, and I believe land, also land, and all these things, they are subject to RAT at 5%. And why it was imposed, because it has one main thing which I had knowledge, that the 15% VAT here on the real estate properties, it was very high. It has a very big impact to those buying the real estate. So for to lower that burden, this RAT was introduced, and these the supplies of these are not exempt from VAT. These supplies of real estate properties, and only this 5% tax is applied on it. So it has replaced the VAT on this supply on the of real estate property, and this is full and final tax, unlike VAT, where VAT is a recoverable tax, but it is the full and final tax rate. Uh, then we come to transfer pricing, another very important aspect. This transfer pricing it is introduced in the kingdom in 2019. So, what transfer pricing is, that it was introduced first of all by the OECD, the Organization of Economic and Cooperation Development. So their guidelines and their rule, this mechanism is implemented, as it is implemented in many other countries also. So the basic purpose of transfer pricing is that the basic purpose is that for the related party transactions, though the related party transaction, to make them this transaction at arm length basis, to ensure that these the transaction with your related parties are at on arm length basis. So when we say on arm length basis, so it means that the transaction with your related party, the purchase considerations and the terms should be such as if you are doing some the transaction with a non-related party. So this is called the arm's length principle, or in easy term, you can say that fair market value. You can also say. So this transfer pricing is also very important because it has quite documentation and compliance requirements. They are those who are subject to transfer pricing. They have to you should have a proper transfer pricing policy, and then there is local file and master file regarding all the facets of transfer pricing, the different mechanism and different the the calculation mechanism which are involved for the different nature of the related party transaction. So this transfer pricing is also very important aspect. And initially, when it was introduced, it was this transfer pricing was only subject to the multinationals. They were basically targeted large multinationals, and so they were targeted for this transfer pricing. But now, gradually, the zakat payers, they are also they are being brought into this umbrella, and from 2024, these zakat payers are also those zakat payers who have uh, these the related party transaction of 100 million or more. They are subject. They fall under this transfer pricing regulation. The requirement, they have to keep the local file, master file, all the requirements they have to meet. And in 2027, this the rate, it will be further reduced from 100 million. It will be the threshold will come to around 48 million. So all the zakat payer, if they have annual revenue of a related party transaction of 48 million, they will also be required to have these TP documentation with them and follow all the TP regulations. So, and for the multinational enterprises, big multinational enterprises, and also the zakat payers who have if multinational status, and their revenue is around 3.2 billion real annual turnover. So they are subject to further CBCR, like country by country reporting and other things, their compliance requirement. So, and also an important thing is that if you have a related party transaction, you have to file the disclosure form of this control transaction. The word it is used in the law is control transaction. This related party, the control transaction, it is used, and you have to file this DFCTs, the disclosure form of the control transaction, along with the affidavit, which is a certified affidavit with the zakat and corporate income tax return. So this transfer pricing is now it's a really part and parcel of the all this tax compliance procedure. And another important aspect is e-invoicing, electronic invoicing. So in this connection, there is a lot of development in KSA that e-invoicing has been implemented here, and the reason to digitize the economy, to automate the economy, to digitize and have more transparency and more control over all the economic transactions, all the economic nature. So this e-invoicing has been implemented in KSA. So there's for in first phase, in phase one, which was implemented, I believe by the end of 2021. What it was done in phase one invoicing, that manual invoicing, it was totally abolished. So for the this especially in the context of VAT, the VAT invoices, they must be manual invoicing was in the first phase, it was abolished, and you have to issue invoices through any electronic form, in through any electronic medium. You have to issue now. Then manual correction, manual adjustment on the invoices was also banished. So it is against the law. We cannot accept VAT invoices with manual correction. And the second phase of invoicing, phase two, it started from 2023. And this in second phase of invoicing, what it is being done, that now the invoices, the VAT invoices are transmitted, are directly, the invoicing system are integrated with the tax authority portal, the Fatura portal. These are integrated. This e-invoicing, electronic invoicing, is done in waves. I mean, in the first wave, they selected very high turnover taxpayers, and then in waves they are implementing this e-invoicing. So what happens that there are two category of e-invoicing. It is either B2B or B2C, business to business. So business to business environment, invoicing, the invoices are cleared at the real time. They are transmitted to Zetka Fatura portal. So your invoices, first of all, your invoicing solution, it must be onboarded on the Zetka Fatura portal, your invoicing solution, compliant invoicing solution. And then your B2B invoices, they need to be transmitted on real time to the Zetka portal, where they validate the invoices, and all there are many security measures, the cryptographic stamp, universal ID, UUID, hash, and tag. Many there are a security measure that they are validated. And once it is validated, then you can give the copy of the invoice in a physical form to your customer. So this is for B2B. We are on a real-time basis. Those taxpayer who are subject to phase two e-invoicing, they have to send the invoices. For the B2C invoices, it is not on real-time basis. It is you have to report all the invoices within 24 hours to ZK. So all the e-invoices in this XML format, they are reported within 24 hours. 24 hours is the maximum which we have to report to ZGA. So this e-invoicing, the main purpose is to more and more digitize the economy. And now what the next step they have taken, they have made a pilot project by which they are introducing these pre-populated VAT returns. So what the invoicing, they have got the invoicing from the taxpayer, they send that to the taxpayer, and you have to match that with what is your actual tax return, VAT return. So this invoicing, it is very much for the reconciliation and compliance purpose. It is also a very important thing which needs to be very dealt very carefully. So this is a major transformation in the KSA tax mechanism. Okay. So now this the basic for this presentation was that we want to have this little deep dive in zakat and corporate income tax, because there are the basic two main pillars of this the system. So I prepared this a couple of slides in which we compare what is the difference between zakat and corporate income tax. So, first of all, regarding the nature, that zakat, it is not a tax. Zakat is not a tax. It is a religious obligation. So it is not governed by any. You can say not, but they have regulations. But the main, it is the Sharia law which governs, and on that basis, on the basis of Sharia laws and fatwas and everything, these the zakat laws and regulations, they are formed. So basically, the nature of zakat, it is a religious obligation, and for individuals, also for the corporate all entities, they have to pay zakat. Whereas the when we see the corporate income tax. So, for corporate income tax, it is a statutory, it is a corporate tax, it is a direct tax on the taxable profits. So, that is a difference. It is a corporate tax on the taxable profits of an entity who is subject to corporate income tax. Secondly, the applicability. So I told earlier that zakat, it is applicable, it is liable only on the entities which are Saudi and GCC owned entities. They are subject to zakat, and uh, whereas those entities which are non-Saudi, non-GCC owned, they are subject to corporate income tax. Their ownership share in the companies, as much it is subject to corporate income tax. So this is a major difference, that zakat is payable by Saudi and GCC owned, whereas the corporate tax is applicable on non-Saudi and non-GCC owned. What is the legal framework? The legal framework, zakat, there's a lot of development. There are many advancements and many changes. So currently there is the zakat implementing regulation under this ministerial resolution number 1007, and which was implemented from 2024. So this is the implementing regulation under which currently the administration, the whole management, filing, and each and every aspect of this Zakat administration, Zakat management, Zakat collection is done under the implementing regulations. Whereas the corporate income tax, it is governed by the income tax law, which was issued in by Royal Decree M1. It was 2004. This Saudi income tax law. So the CIT is governed under that income tax law. And one thing I want to just give information that a draft for CIT also the ZK have they are giving new draft regulations for this also for income tax also, but it is and it was given quite around more than 2 years ago, but it is not still implemented. So the draft new law, it is under you can say its process, and it will be implemented, and it has many things implication on the tax residency, and on the withholding taxes, and there are many things in that. But their draft regulation, they are not implemented. So it's still the 2004 income tax law. This it is followed. Then we have the return filing deadline. For return filing deadline is we have to file the return for zakat within 120 days from the end of the financial year. So if a company whose financial year is ending at December 31st, which 99% of the companies their financial year end, so they have to file the zakat return by 30th of April. They have 120 days, so they have to file the return and pay the zakat obligations by 30th April within 120 days. And it is similar in this both corporate income tax and zakat similar, that zakat is corporate income tax is also be paid within 120 days from the end of the financial year. So if some entities filing corporate income tax, it has also, and its financial year ending on December 31st, so it has to file the return by 30th April. And then we have the calculation base. So for zakat, we have the zakat is applied on the zakat base. So how the zakat base is calculated? There are basically two methodologies. There is this current method, a direct method and indirect method. In direct method, there is the you have to the zakatable those assets you have to deduct from those zakatable assets the liabilities pertaining to those assets. So in rough terms, you can say current assets minus current liabilities. That is the direct method. But the ZK does not endorse that method, and ZK has endorsed indirect method of calculation of zakat base on which the zakat is applied. So what is indirect method? Indirect method is a sources of funds method. In this method, that you aggregate your internal sources, that equities and equity equivalents, and also the external sources. You accumulate these external sources of fund, like long-term liabilities and their equivalents. So these sources of funds, they are aggregated, and out from them the non-zakatable assets, the long-term fixed long-term assets, these non-current assets, they are deducted, and you arrive at the zakat base. So This procedure, Mr. Noman, he will further he will show you in detail. So basically, this is the sources of funds method which is applied for zakat based calculation. Whereas for corporate income tax, it is applicable on the net taxable profit, the profits after necessary adjustment on the net taxable profits. 20% CIT is applied. Uh, Secondly, for tax rates for zakat, as per the Sharia law, also that 2.5% is applicable on the zakat. With this 2.5% the rate, but you know that it is this 2.5% is for one lunar year, or this call or hall also. So. But for those entities, because the major entities, they are running on a Gregorian financial year. So in Gregorian, the number of days are larger, 365 days, whereas lunar year 354 days. So for that, this zakat, this effective rate is adjusted, and they have to give zakat at 2.5775% of the zakat base. Whereas for corporate income tax, that it is applicable on 20% of the taxable profit. So this is a general rate on the taxable profit. 20% is applied, and but there are, I told you earlier that there are higher rates to oil and hydrocarbon sector, which are from 50 to 85%. CITs are applied there, but the general rate is 20%. Then we have the mixed entities. Mixed entities are those which have both Saudi GCC shareholding and also non-Saudi shareholding. So these are called mixed entities. So in these mixed entities, the zakat is applied to the shareholding percentage of the zakat base. Whatever the Saudi shareholding percentage, it is applied on that zakat base according to their shareholding percentage. And whereas uh, for mixed entity, for the non-Saudi shareholding, from the net adjusted profit, this CIT is applied on their shareholding, non-Saudi shareholding. This percentage is applied on the net adjusted profit. So this is the treatment for mixed entities. Also, there is in zakat, we have a concept which it is given by the new zakat resolution, that there is minimum zakat base and maximum zakat base. What is minimum zakat base? It is a lower of net deducted assets plus profit adjustment. Lower of, we have to check the net non-deducted assets plus profit adjustment versus adjusted net profit. In from both, we have to take the lower. This is the minimum zakat base. So this is a minimum zakat base on which zakat is.
Adil, I'm sorry to cut you. Just to give you an heads up that we have to move to the next agenda. So you have like next 5-7 minutes. You have to wrap up, please.
Okay, okay.
Thank you. Thank you.
Okay. The maximum, there is maximum zakat base also concept, that the equity and equivalents plus the net profit adjustment. This is the maximum zakat base. So this will be further elaborated when we show you the zakat calculation. And whereas in corporate income tax, there are no such range. Uh, just secondly, on the economic basis, this zakat is on the net worth basis and more a balance sheet approach rather than an income statement based approach. So, whereas for corporate income tax, it is had a income a profit based approach. So this is the economic basis is different for zakat and CIT. Also for consolidation, for consolidation of zakat, there is you can make a consolidation in zakat. If your subsidies for 100% owned subsidies, you can consolidate and form a zakat group. So a holding company who has 100% owned subsidies, they can consolidate and form as a zakat group. So but for that ZK approval is required, and then you can file a consolidated group return. But for the information returns will be still submitted for the subsidiaries which are consolidated. Whereas in corporate income tax, the consolidation is not allowed, and each entity must file its separate return. Regarding depreciation expense, like there is some expenses admissibility. There are some different criterias in zakat and CID. Like for the main is depreciation expense. That for depreciation expense, that ZK it accepts the depreciation which is reported in the book of accounts. So ZK accepts it. Whereas for CIT, they have given specific rates of depreciation we are on different asset categories. So you have to calculate the tax depreciation, and then you have to make the necessary if there is difference. So what we have to do is to add back the accounting depreciation, and then we will adjust the tax depreciation, so that here it is different in treatment of depreciation expense. And advanced collections, there is no concept of advanced collection, but in a corporate income tax there is concept of advanced tax collection. So advanced tax collection, they are if an entity has a profit of in preceding year it has a profit of 2 million or more, then it has to pay in the next year advanced tax also in three installments: 6th, 9th, and 12 months. So they have to pay the advanced tax also. Similarly, for the statute of limitation, it is 5 year. It is both the same for zakat and corporate income tax. The statute of limitation is 5 years from the end of the financial year. So the zakat authority, they can go back only to 5 years. But in case if you don't file the return timely, then this statute can be extended to 10 years also. So this is about the statute of limitation. So mainly objective. Previously, I told that the objective for zakat is distribution of wealth and for social welfare, whereas for the objective of CIT, it is basically revenue generation for all the public finance, for providing facilities, the providing the needs to the public, to the society. So this objective is also different. And last, the loss treatment. In case of zakat, the loss is automatically it is adjusted from in the equity. It is a reduction in the equity as per the value of the statement of financial position. It is it's a reduction in the equity. But for corporate income tax, the losses can be carried forward. Losses can be carried forward to the next year, and there they can be utilized. Okay, one I will, time is also actually little limited. So this one I've prepared a slide in this context is on the overview of audit and appeal process, because it is the major concern for every taxpayer. These tax controversies, how to manage them effectively. So basically, this is the steps normally which are taken under the audits, the litigations. Initially, when you file the return, after that, you can for those year you can get audit notice from the ZK. They issue audit notice, and they want additional information and documents and supporting evidence. So normally you have to provide them by 20 working days or the date which is specified. Then once there are usually two or three transfers of this additional information or clarification, explanation, then they may issue as draft assessment that on those areas which they disagree and which they have objections, they issue draft assessment, or in some cases draft assessment is not issued also. So you have to reply to them on 10 to 15 days. If the draft assessment you are able to satisfy ZCAT, then it's okay. But if they are not satisfied and they have objection on your tax assessment, then they can issue final revised assessment of your zakat or tax and the applicable penalties on it. So you have 60 days from the date of notification to object for their final assessment. So first, once ZCA has issued final assessment, you have to object to the internal committee of ZCA. You don't have to go outside. You have to, within ZCA, you have to file an objection within 60 days from the final assessment. If you file the objection and you provide them all the additional information and whatever their requirements, you try to satisfy them. So if it is cleared at this stage, otherwise, if they may reject it partially or all, maybe your objection is rejected. So after that, you have to you can move. Then you have 30 days to move to the GSTC, the General Secretariat of Zakat and Tax Committee. This is the GSTC is a independent body for these tax disputes resolutions. So it has two levels, level 1 and level 2. So if your objection is rejected by ZCA, then you can go to GSTC level 1, which is Tax Violation and Dispute Resolution Committee. You have to file there. And if your case is still got rejected, if you still they didn't accept, then you have to go to the GSTC level 2. 30 days you have to give to GSTC level 2. And this GST level 2 is the final decision. So it is you cannot appeal of decision to any other authority. So this is basically audit and appeal. Uh, and a little bit, if Faisal bhai, I could have a couple of minutes, I will.
Sure, sure, sure. Just try to wrap it up in the next two, three
Okay.
minutes.
But last thing is this withholding tax. Actually, withholding tax, we are planning to have a separate because it is also very vast subject. But since it is related to this CIT, so withholding tax, I already informed that it is applicable when you make payments of services to non-resident entities, non-resident entities. When you make payments, so withholding tax is available and applicable, and is applicable from 5 to 20%. The general rate is 5% on the technical and consulting services, but there are also many other categories: royalties, rent, dividend payment. If you make dividend payment to a non-resident shareholder, you must deduct 5%. So this is basically withholding tax, and it is filed by the 10th of the next month, monthly withholding tax by the 10th of the next month in which you have made the payment. And annual withholding tax we have to also file. It is the same like we have 120 days from the end of financial years. And last thing is that you can under the double tax treaties, double tax avoidance agreements, which Saudi has signed with many countries. So for those non-resident suppliers who are residing in those countries, if you can get withholding tax exemption, or alternatively you can get withholding tax refunds. So that is a very also long process. So basically this is the withholding tax aspect, which and this is I've tried to cover all the major areas of the KSA tax environment and the zakat and corporate tax. And I hand over to Mr. Faisal for
Thank you.
further. Thank you.
Thank you, Adil. Thank you very much. Very insightful. If you guys have any question with respect to the material or the presentation, you can definitely ask in the chat box, or we towards the end of the presentation or this webinar, we'll also be taking the question answer from the participants. Our next participant, the lead panelist is Mr. Noman. Noman is a very well known tax expert in the region, very seasoned professional, very experienced. I'll hand over to Numan to take it over from here. Numan, you can share your screen, please, and move on.
Thank you, Faisal. In this cloudy environment, 28 degrees centigrade in Jeddah, I think best weather for Jeddah people. Again, the April 30 deadline is approaching very fast. The main purpose of this webinar is to equip you in case if you are not yet being ready with your submission of zakat and tax return. The purpose of this presentation, the next part of this presentation is so you are now, I'm sure, by the first segment of our presentation, which was presented by our colleague Adil. You are already now aware of the taxation in KSA. Now it's time to have just a deep dive into how the zakat and tax are being calculated. Let me start sharing my screen. Okay.
Yeah, we can see it now.
You can see my screen, correct?
Yeah, yeah.
Okay, let me just put it in the presenter mode. Just a second. Okay, let's start with the calculation. Again, I'm sure that you have attended several seminars. Annually, Big Fours are being conducting various seminars to give you updates with respect to the changes in the regulations uh, and the taxation framework. However, this session is specifically going to be having a deep understanding of how the calculations of the zakat is being made, zakat as well as the corporate income tax in KSA. Plus, we are also going to guide you about the filing process, how the filing is being done in the KSA when you are a KSA entity having registered with the tax authority for zakat and income tax. Again, we are going to touch base some of the important terminologies, minimum zakat base, maximum zakat base. This is something, new terminologies introduced in the MR 1007, Ministry of Ministerial Resolution 1007, introduced back in 2024, effective from 1st of January 2024. Again, retrospective application is also available. We will discuss some of those details subsequently, but these are the key concepts that are being introduced as part of the MR 1007, which was not there previously. So yes, what happens? The Zakat regulations continuously kept on updating, and several concepts are being updated. Again, the whole and aim is to ensure that the Zakat uh, calculation are being met in a way how it has to be there in order to ensure that there's no underpayment of zakat. Let's move to the next one. For to ease the calculation, I just split the calculation into three steps: step one, step two, and step three. Step one is the calculation of the zakat base. Step two is a new concept of minimum and maximum zakat base. And the step three, whatever based on the step one and step two, we are going to have the zakat base going to be, we are going to apply the rate. Again, I think the rate part has already been covered by Adil in his presentation. I will just skip how the rate are being different in case if you are a Hijri based entity or if you are Georgian based entity. Let's move next. Step one. Again, I have splitted step one into two steps, A and B, just to be ensured that we can visualize our zakat calculation with our financial records. So when we are talking about the step 1A, you can just visualize the income statement part in your financial statement. Yes, so in the step 1A, we are going to start with the net profit or loss appearing in your financial statement, which are being prepared in accordance with the IFRS or the accounting standards applicable in Saudi Arabia. Starting from the net profit and loss, those who are in Saudi Arabia for a couple of years or for a long time definitely are aware that prior to MR 1007, always the zakat calculation was starting from net profit and loss before zakat and tax. So profit and loss before zakat and tax was the starting point at that time. This is the first change that has been made in this MR 1007, that the starting point become net profit and loss. What is the reason? Hopefully, we will have some time in the last segment of the session. You can definitely ask the question and we will be explain the concept to you. Uh, some of the changes, some of the amendments are required. Again, the numbers which you are looking here are have been taken from the live example of one of the entities, just to ensure that we are not working on some fictitious numbers, but definitely make sure that the purpose of this presentation is just to give you the overview for the general informational purposes, and it is not intended to be relied upon as an accounting, tax, legal, or other professional advice. You should definitely require to refer back to your advisors in case if any specific advice is required. Going back to the calculation part, so after getting the net profit and loss from your financial statement, income statement part, uh, you have to adjust your profits. Why? Because uh, based on the concept coming from the zakat perspective, some of the expenses are not allowed. For example, entertainment expenses. Yes, accounting accepts the entertainment expenses as the expenses related to the business. However, the zakat does not accept entertainment expenses. Similarly, there are some taxes and zakat other than the zakat and income tax and expense separate line item in your financials. If there are any taxes and zakat which are being reported as part of your G&A, as part of your cost of goods sold, as part of your as sales and marketing, sales and distribution, for whatsoever reason, I can give a quick example of the withholding tax. If you have withholding tax and expense appearing in your books, what does that mean? That instead of withholding the tax from your supplier, you have recorded this or you have borne this as an expense. Definitely, this simply means that you are going to have the the zakat and taxes to be added back to your profits. This means that your profits are going to be increased because of this added back activity. Moving to the next part, any other expenses which are not related to your operational activity has also to be added back to your profit and zakat base. In this example, the company which I have picked the example have some gifts. Again, those gifts are not considered as something related to the operational activity of the company, and accordingly, it has to be added back to the zakat base or the profit. Uh, Based on sum of all those, it comes to the 528,000 as an adjustment to the profits. That brings us a zakatable profit. Usually we use the word taxable profit, but I still prefer to use the word zakatable profit because again, it is not a tax, it is a zakat, a separate chapter in Islam. So let's say it is a zakatable profit, which after having the adjustments come to 64 million. Next, step 1B. So after covering the income statement from our financial statement, let's move to the second step, which is the zakat base calculation. Again, the zakat base calculation is based on the balance sheet. If you go back to the first segment of this presentation, Adil has clearly explained to you that the economic background of zakat is coming from the balance sheet, whereas in CIT, corporate income tax, is coming from zakat. Okay, let's see the zakat base. Zakat base, when we are talking about how to calculate the zakat base based on the balance sheet, first element is the owner's equity. Again, as explained in the first segment by Adil, there are two ways to calculate the zakat. One is the direct approach, one is the indirect approach. Usually, when myself, and I'm sure that you as well, being a Muslim, when calculating your zakat, definitely you're using the direct method, which is what is the cash I have, what is the inventory I am having, what is the gold or silver I am possessing, or equivalent to that. This is how I am calculating my zakat base. This is called a direct method. However, the method that is being adopted by the KSA authorities under the zakat regulation covering back in MR 1007 as well, this is indirect approach. In indirect approach, you start with your equity. Instead of your assets, you start with your equity. So here you're going to take the owner's equity. In this case, in this example, the owner's equity is around 419 million. Let's see what does the owner's equity comprises of. Okay. Owner's equity definitely have the numbers coming from your financials, which are like capital, statutory reserves, retained earnings, including the current year profits and losses, any OCI reserves, any partner loan treated as equity. These are already elements coming treasury shares as well. These are already elements coming from your balance sheet owner's equity part. What has been changed in the MR 1007? They said don't only consider your owner's equity as per your financial statement. Okay, what has to be done next? You have to add the provisions as well. All the provisions except the employee related provision, especially the end of service provision, especially the provision related to employees' vacation. These are the provisions that are not going to be part of your owner's equity. All the other provision has to be moved from the liability side to the owner's equity part, including the tax and zakat provision as well. So if you now try to jot down what has been communicated in first step 1A, that now we are taking the zakat after zakat and net profit after zakat and tax. This is the second part of the story. Now you have to add the tax and zakat provision as part of your zakat base. Previously, we used to start before zakat and tax, and that is the reason tax and zakat provision were never added to our zakat base. Dividend distribution, again, this is the change that has been introduced by MR 1007. If you have declared the dividend, but the dividend has not been settled yet, again, those has to be reconsidered back from liability to the owner's equity. Moving back, so first part was owner's equity, second part was the liabilities and the equivalent. Previously, when we were talking about the liabilities and equivalent, it was only the liabilities which are considered as long term, either because those who are considered and classified in your financials as non current, or because it exceeds a howl. Okay, but MR 1007 has removed the concept of howl. Now they are saying just go with the closing balance. Going with the closing balance, I think this is more practical approach. Even when we are doing the calculation of our individual zakat, we are just ensuring the whole only for the first time when we are saying that yes, we are now zakat payer. But eventually, whenever we are calculating the zakat, it is always based on the ending balance, closing balance. Similarly, this concept has now been adopted in the MR 1007. Now the concept is based on the closing balance. But the concept has been expanded. Now it's not only the non-current liabilities that used to be added, which were exceeding for 1 year or classified as non-current liability in your financials, plus something, the liability, any liability that is financing your fixed asset has to be added as well. In addition to this, end of service benefit provision and the vacation provision or other employee related provision, which were not added in the owner's equity in the previous slide, as explained to you, have also to be added under the liabilities and the equivalents. Then MR 1007 has introduced some new concept. They are saying let's focus here. Let me just make the pointer. Okay, let's focus on 13 and 14. They are saying what is going to be added to your zakat base is the minimum of this line number 13 and line number 14. What is line number 14? We are going to cover in next slide because it is part of the deduction in the zakat base. So now we are discussing the addition to the zakat base. This is going to be covered under the deduction section of the zakat base. Let's see what is number 13. Number 13 is whatsoever as part of the liabilities. Example, in this case, in this company which I have selected, they have the lease liabilities, they have the long-term loans, they have some deferred income, they have the end of service benefit, they have the vacation provision. All these has been added. Plus, they are saying, let's see, if there are assets, fixed assets that are being so let's say non-current, so there are non-current assets that are excluded from your zakat base. Okay. Sorry, when the non-current asset is not excluded and you have taken those as part of your deduction, see the percentage of those assets as part of your total non-current asset. Based on the percentage that is going to appear, apply that on your non-current liabilities. What does that mean? Add the proportionate part of the non-current liabilities based on the non-current assets which you have taken for the deduction from your zakat base. Concept is they assume that this portion of your non-current assets are being financed by the non-current liabilities. Then you have the current liabilities as well. So now under the MR 1007, some of the current assets are allowed to be deducted. It was not the case previously. Okay, what does that mean? That means in case if you are going to have the deduction coming from the current asset, take the proportionate of that portion of the current asset out of the total current asset and apply this to the current liabilities and add those as well. Fortunately for this company, we don't have any current asset as a deduction, so there's no addition to the zakat base as well. Based on the calculation above, compare it with the total deductions. Whatever is the lowest number minimum number, go add it to the zakat base. I hope the concept is clear. But again, we are going to have the last segment for the question and answer. Please keep your questions ready. I'm sure we are going to have some good discussions moving forward. The last part, what has to be added in your zakat base? Because again, when you are taking your owner's equity, you took the retained earnings from your financial statement. That simply means the zakat adjustment, which we saw in this slide, this part of the adjustment to the profit was not added. Now this is the time to add these adjustments as well in your zakat base. That brings the total addition to your zakat base. Next is the total deduction. What has to be deducted from the zakat base? First thing that has to be deducted from the zakat base is your non-current assets. What comprises under the non-current assets? Let's have a quick look. Same, what is coming from your financial statement? Your fixed assets, your intangible assets, biological assets, employee housings debts, regulatory deposits, and other non-current assets, including the deferred tax asset as well. All these non-current assets are now allowed to be deducted from your zakat base. In case if you have the investments inside KSA or outside KSA, in the funds, in the companies, subject to certain rules, you are allowed to deduct those investments as well. If you are a contractor, you have the properties and projects that are under development, but definitely that are going to be sold. You are allowed to deduct this as well from your zakat base. Similarly, as I explained in the previous slide, MR 1007 is now allowing some of the current assets as well for the deduction. Let's have a quick example of the current asset. Again, in this company, we don't have this example. That's the reason why all these are zero. But just to give you an example, yes, MR 1007 has allowed the delayed government receivable to be deducted from your zakat base. That was never there in the zakat regulation. Yes, there were some fatwas, some case rulings that were already there, but it was never part of the regulation. Now that has been bring in the regulation as well. Okay. After having addition and deduction, what does the addition and deduction brings to you? The addition and deduction brings to you the total zakat base, the sum of the total addition and the total deduction less the total deduction is going to bring the total zakat base for you. By this way, step 1 is completed. Let's move to step 2. Additional calculations, minimum zakat base and maximum zakat base. What does the minimum zakat base and maximum zakat base actually means? Previously, when the MR 1007 was not introduced, it used to be that zakat has to be paid on higher of adjusted net profit and your zakat base. Whatever is going to be the higher, this is where you have to pay the zakat. Now the new concept of minimum and maximum zakat base has been introduced. Let's see when it is applicable. Let's take few cases. Let's go with backward scenario. Your zakat base and your adjusted net profit both are negative. What does that mean? That no zakat is going to be applied. Let's say your zakat base is positive, but your adjusted net profit is either you have no adjusted net profit or it is lower than the calculated zakat base. In this case, zakat will be computed on the zakat base or the maximum zakat base. We are going to use the minimum zakat base. Let's try to understand. So previously it is going back again to the basics. It was higher of the adjusted net profit and the zakat base. Now they are saying it's not only the higher of net profit and zakat base, rather it is going to be the net profit, or so they're saying take the minimum, take the zakat profit, zakat payers adjusted net profit, and see what is your total non-deductible assets. What does that mean? Out of your total assets as per the balance sheet, minus whatever has been put under the deductible assets. Okay. So if you see here in this example, the total assets as per financial statement is 1.2 billion. Let me just make the pointer. Yes, okay. Now you can see the total assets as per the financial statement is 1.2 billion. However, we have deducted the assets 646 million. They're saying, okay, sorry, we have deducted around 500,000 in the previous slide. If you remember, 599 million was deducted from your zakat base. So total assets minus deduction brings you the non-deductible assets, which is 646 million. They're saying, what is going to be your zakat base? Your adjusted net profit, okay, or the non-deductible assets plus the zakat adjustment. So definitely my adjusted net profit, if you go back in the previous slides, you can see my zakatable profit after adjustment was 64 million. Definitely this is the lower one. So for the minimum zakat base, I'm going to take my minimum zakat base as the adjusted net profit. Let's see the maximum zakat base. Again, the new concept. What does the maximum zakat base actually means? It means take your owner's equity, which you have taken in your zakat base. Add also the zakat adjustment as well. This should be your maximum zakat base. You should not be paying the zakat more than this. Is it good for the zakat payer? I can say yes, especially in those cases, because I myself was part of one of the case where ZK has added all the current liabilities because they were assuming that it is a revolving loan and it exceeds the whole. So they were considering the whole liability to be added to your zakat base. Definitely, when you are having big loans in your financials, adding the whole amount to zakat base will give you a big shot. This will at least have some cap. By this way, you are going to have a cap. So after having step one, which was the adjusted net profit and the zakat base, step two, minimum zakat base and maximum zakat base, what next? Just see where you have to pay. So you are going to pay either based on the zakat base calculated in the step one or the maximum zakat base calculated in the step two. You are going to take the minimum of the zakat base calculated in the step one and the maximum zakat base calculated in the step two. So the minimum of A and B is going to be 53 million because the zakat base which we have calculated was 53 million. Okay, this is one of the criteria. What is another criteria? What is the minimum zakat base? My minimum zakat base was 64 million. Now I have to take the maximum of minimum zakat base or the zakat base coming from the above calculation, which is the minimum of the zakat base calculated in the step one or the zakat base calculated as a maximum zakat base in the step 2. This is now going to be my final zakat base on which I am going to calculate zakat. Again, zakat by Sharia, it is 2.5%. However, wherever you are going to have your zakat being calculated based on the Gregorian calendar, or it is the first year of your operations, you have to adjust based on the number of days in the year. Accordingly, since it is the full year zakat based on the Gregorian calendar for 2024, the zakat rate has to be calculated as 2.5% divided by 354, which is the number of days in any Hijri calendar year, multiplied by number of days in the Gregorian calendar, which was 366. That brings 2.5847%. Applying the zakat as base, 64 million, brings us a zakat of 1.6 million for this company. By this, we have calculated the zakat, or we have seen how the zakat has to be calculated practically for the companies who are 100% zakat based companies. I have taken the same financials, assuming that it is 100% on corporate income tax, 100% non-resident or 100% non-Saudi owners, which means it is going to be 100% CIT. Very quickly, the CIT is bit straightforward. Again, I make it simple for you. Split it into step 1, step 2, and step 3. Step 1, calculate the taxable profit. Step 2, adjust the carried forward losses. Again, Adil have already explained in the previous segment that in the taxation, you are allowed to adjust the carried forward losses. What is the period? There's no period. You can adjust forever. And then step 3 is the rate. Apply the rate. Let's see. Same numbers coming from my financial statement, income statement, net profit and loss. Again, as a concept, in the CIT, it is always the net profit before zakat and tax. But since in the filing, and again, once we are going to shortly moving to the next segment, next part of my presentation, which is the filing status or the filing step, you will be able to see it's a unified return. You are going to use the same return in case you are a zakat payer entity, or you are a corporate income tax payer entity, or you are a mixed entity. You are going to use the same. That's the reason why I also start with the net profit. You can see here the zakat and tax expense 9.1 million has been adjusted here already. The first 3 elements are the same which was in the zakat as well. So the concept for the first 3 elements is very similar in the zakat or the income tax both. Provision made during the year previously, before the MR 1007, provisions made during the year was added back also in the zakat. MR 1007 has allowed the provisions as an expense in the profit calculation when we are talking about zakat. But in the corporate income tax and conceptually, the income tax does not allow the provisions. That's the reason all the provisions has to be added back, except if there are the provisions that are being settled during the year, that portion is going to be deducted from the profits. So for example, I have 20 million of the provisions this year, but next year out of this 20 million, I'm going to settle, or it actually become the expense by 10 million. That 10 million has to be allowed as adjustment, positive adjustment, or as a deduction to my profits for the next year. Then there are some threshold for the repair and maintenance cost. I think is a 4% based on the group value of the fixed assets as per the calculation of the fixed asset in accordance with the tax regulations. Similarly, you are going to have the depreciation differences. What does the depreciation differences? Again, this is a very unified concept across the globe whenever we are talking about the corporate income tax. Whenever it is whenever we are discussing about the fixed asset, you are going to have the fixed asset register in two steps. One, the fixed asset register as per your accounting records, as per what is being part of your financial records. Then you are going to have the fixed asset register as part of your taxable return. Because what is the basic difference between the fixed asset register as per zakat, as per tax, and fixed asset register as per the financial records? Principally, accounting under the IS 16 allows you to select different kind of accounting or to select different kind of the depreciation methods, whether it's a straight line, whether it's a diminishing method, whether it's based on number of units. There are multiple methods allowed. However, in KSA, under the tax regulations, the only method that is allowed is the diminishing balance method. Plus, there is a special calculation method. Let's see how it works. This is going to be the fixed asset depreciation. I'm sure those who are working in the those who were previously working for the zakat return as well can clearly see that previously we used to have 10A and 10B. 10A was, I think, for zakat payer entities, and 10B was for taxpayer entities. Now, MR 1007 has removed the 10A. Now, you have seen in my regular zakat working, this schedule was not there. Previously, it used to be there. Now, the zakat accepts the fixed asset as per the accounting records. Tax is still following the same school of thought that fixed asset for the taxation has to be kept separately. I will not go in more details that how it is being worked. Conceptually, it starts with the last year balance. Again, based on the diminishing balance concept, the last year book value as per the zakat fixed asset or as per the tax fixed asset register. Then you have to add the 50% of the previous year addition, whatever the fixed asset that has been added to your financial records in your fixed asset register, add 50% out of it. Similarly, what is the current year addition? Add 50% out of it. And then based on the rates given by the tax authorities, whether it's a 5%, whether it's a 10%, or 25%, 20%, different rates are being given based on different categories of the fixed assets. Accordingly, these rates are going to be applied on the book value, which is based on those additions. That brings you the depreciation based on the tax loss, which has to be compared with accounting depreciation, which brings you the depreciation difference. This depreciation difference is going to be added back in your corporate income tax, and that definitely is going to bring the deferred income tax for you. By this way, after all the adjustment which are shown here, it appears to be 27 million. This brings my net profit and loss from 63 million to 90 million. Step 1 completed. What is step 2? Step 2 is simply what are your carried forward losses? Sum all your carried forward losses. You are allowed to adjust your carried forward losses to the minimum of 25% of your current year taxable profit or your tax losses. So in this example, you can see since my minimum tax, since my taxable profit was 90 million, I am taking 25% of it, and I'm seeing what is the total carried forward losses for me. So that carried forward losses for 11.5 million. The minimum of the both is going to be the 11.5 million. This 11.5 million is going to be adjusted out of my 90 million. Let's move first to step 3. Tax year profit 90.5 million. Carried forward losses adjusted 11.5 million. Residual tax year profit 79 million. Corporate income tax rate, as explained by Adil, it is 20%. This brings the corporate income tax of 15.8 million. With this, it completes my first part of the presentation, that how the zakat and income tax has to be calculated. I'm sure, even though I tried my best to make it simple for you, to make it understandable for you, definitely you're going to have the questions. Feel free to ask in the Q&A session in the last part of the presentation. Moving to the zakat and tax return filing process. Again, I'm sure most of you are having the consultants who are doing the filing process for you. However, we want you to be equipped as well, at least to be aware how the process works. I'm just trying to play the video. I have taken this video, it's a 1-minute video from the ZK website. Unfortunately, it is in Arabic. Those who understand Arabic can easily understand it. However, in the next slides, I'm going to explain very quickly how the zakat and tax return filing works in KSA. Sorry for the...
I'm writing my own story. My style explores every version of who I am. Shop my tabby bag at Coach.
That is not from me, that is from the YouTube. Let's see.
كيفية تقديم الإقرار الزكوي. ادخل إلى موقع هيئة الزكاة والضريبة والجمارك. من قائمة الخدمات الإلكترونية اختر تقديم الإقرار الزكوي ثم أيقونة الدخول للخدمة. سجل الدخول بالرقم المميز أو البريد الإلكتروني وكلمة المرور. أدخل رمز التحقق الذي وصلك في رسالة نصية. من قائمة الإقرارات اختر الزكاة وضريبة الدخل واختر الإقرار المراد تقديمه. اقرأ الشروط والأحكام ثم وافق عليها. ستظهر لك المعلومات الأساسية، أكد صحتها واضغط التالي. أمامك قائمة الدخل، اضغط التالي. من قائمة احتساب الزكاة قم بإدخال بيانات إجمالي الموجودات من واقع القوائم المالية وبيانات مجمل الربح أو الخسارة كما في القوائم المالية والقيمة العادلة السلبية للمشتقات المستحقة طويلة الأجل. ستظهر لك قائمة المركز المالي حيث يمكنك مراجعة بيانات الأصول والخصوم وحقوق الملكية، ثم اضغط التالي. أمامك الآن قائمة تسعير المعاملات، اضغط مراجعة، أكد صحة المعلومات وأرفق المستندات المطلوبة ثم اضغط تقديم وموافق. الآن تم تقديم الإقرار بنجاح وسيخضع للمعالجة، ويمكنك الاحتفاظ بملخص الإقرار والرقم المرجعي. خدماتنا وين ما كنت.
And I can definitely say, those who are living in KSA for many years, the process of zakat return filing has really been updated by the tax authorities. It was definitely not as simple as you can see in this 1-minute video. Previously, it used to be a very tidy process where the physical copies of the zakat and tax return used to be printed, signed, stamped, submitted to the consultant, and then the consultant was going to the physically to the office of the tax authorities, standing in the queue, especially in the last days, till you have your financials or the zakat return being submitted. And definitely hats off to the KSA authorities. It has now been very simple to file your zakat return. Definitely you can do your filing as well yourself. You don't need to have any consultant doing this, but definitely having the consultant is always an edge because it helps you to avoid mistakes. It helps you to bring someone on board who is more experienced, having dealing with these kind of cases on daily basis. Our purpose again is to equip our members, our listeners, to understand how exactly the filing process work. Just go to the ZK website, select the login. You will find different platforms. Select the Zakat and Tax Services. It will ask you that you are going to move to a another platform, proceed, put your account details. I'm sure that everyone who has a registered TIN number already is having a registered uh, username and password as well to log in into the system. You will find a tab under the Zakat that shows the return of income tax and Zakat that are due for submission. Here it is showing one, that means one Zakat return is pending for or is due for submission. As soon as you will click on that one, you will find different Zakat return appearing. Search for the one which is unsubmitted. Make sure that this is the same fiscal year you are going to file. As soon as you're going to click on this portion, you will find the terms and conditions. So you will have these all tabs soon coming in. Agree on the terms and condition. Again, you don't have any option to disagree. So just agree. If you want to read it. Good to read, but you have to accept. If you have to file, you have to accept. So agree, accept the terms. See the basic information. Make sure that this is your Zakat return, your entity name is appearing, the current fiscal year period is correct. Sometimes it is not correct. What to do if it is not correct? You cannot change anything here. You just has to go back and go to your tax registration information and change it from there. Next. It will again going to show you the how many number of CRs you are having, what is your status, are you resident, non-resident, what is the share of the capital of the Saudi, non-Saudi. Here it is showing zero, but it's not zero. You'll see in the next screen. Again, you have to, if you're going to say that no, above registration details are not correct, then it will take you out from this submission and will ask you to change your registration details. So if you continue, you have only option to select yes and continue. At this stage, the first portion after the terms and condition and the basic information is the income statement. I will just take 5 minutes to complete this and we'll move to our next segment. Income statement is going to have cover whatever is in your financial statement is going to cover everything under the income statement, under the income cost to bring the net profit and loss matching your financial statement. First portion is the income. Second portion starts with the cost of goods sold and then move to the expense. I think the captions are very straightforward. You just need to map them with your financial statement. The only thing which is a bit technical, that is the cost of goods sold part, especially for the entities who are manufacturing concerned. Those who are in a trading business, it is very straightforward for them. It is going to match almost with the cost of goods sold reported in the financial statement. However, for the manufacturing entities, it is not straightforward because when ZK is discussing the cost of goods sold, they are specifically looking into the inventory movement. All the other part of your overheads, your labor, has to be reported separately in a specific line items under the expenses. Once you complete everything, you can see there are some of the elements where you can see applicable, not applicable option. What does that mean? That in case those are applicable to you, you have some expenses to be reported under these lines. You have to fill the details as well. As soon as you click on applicable, a new form is going to open where you have to complete your the information of your subcontractors and the the party-wise information for all of these entities, for all of those expense type. Not all, but most of them are there. Go see sometimes some of the auditors require you to report the GOSI separate as a separate line items in your financials under the requirement of the IS 19. However, you need to split the GOSI between Saudis and non-Saudis. Okay. Let's see what's next. Next is the adjustment. These are the same adjustment which I discussed with you in under the zakat adjustments and the income tax adjustment part. Again, there are definitely certain schedules. As soon as you click on applicable, those schedules are continue to be there. Next is the balance sheet. Balance sheet means the zakat calculation step 1B. If you recall how I've presented to you, same elements are there. You need to have the same. In case of applicable, you need to fill the information. It will bring you to the next part of the balance sheet or the zakat base, the deduction. So after the additions, you have the deduction as well. That brings the zakat that brings the deduction based on the zakat base, that brings you the total base. After the total base, again same concepts. After the step 1 is completed, you are going to step 2, minimum zakat base, maximum zakat base. Based on total base, minimum zakat base and maximum zakat base, based on the formula minimum of the minimum zakat base and total base, and the maximum and the minimum of the maximum zakat base and the calculation coming from above, your zakat base will be automatically be appearing here. So the same formula, same thing which I explained to you in the calculation, the formulas are already there in the portal. As soon as you start putting the numbers, the final zakat base will be calculated. Similarly, the zakat payable based on the number of days in the Hijri in the Gregorian calendar, or based on your first year of operation, the number of days that the company was operational, the zakat will be calculated accordingly. If you recall, I have explained to you under the deduction that investments are also allowed for deduction if those investments are not in the local entities or not in the entities who are paying the zakat. Then the zakat has to be calculated separately for those entities and has to be added here as well to calculate the total zakat payable for your company. After the total zakat payable, you have a taxable amount, which is the taxable profit. Then you have to adjust your carried forward losses. Again, same concept of 25 up to 25% of the current year profit. That brings you the income tax payable. Same what we have discussed in the calculation. You just need to start putting the numbers. Then the system we are required will ask you to fill the form or the subsidy or the details, and the system will calculate the taxes accordingly. That brings you to the balance sheet part. Balance sheet again is the assets, liabilities, and equity. You just need to map your financial statement balance sheet with the zakat return in this filing process. Then it will bring you to the transfer pricing. First question is, do you have any related party transaction? If you say no, no details will appear. You will be moved directly to the submission part. If you say yes, and when you have to say yes, this is very important thing. If you are a corporate income tax entity and you have related party transactions, you have to say yes. If you are a zakat paying entity, the transfer pricing regulations is applicable to you currently for I think more 2 years, only in case your transactions with the related parties exceeds 100 million. Only in this case you have to fill yes, complete all the details, including as explained by Adil. You have to upload the affidavit as well. You have to ensure that yes, you are preparing the local file and master file as well, and you have to respond that in case you are part of a bigger group. Again, the same concept of CBCR which was explained by Adil. In such case, if you are going to say yes, you have to fill the details that who is your ultimate parent entity, who is going to submit the CBCR. If you say no, no questions will appear. Just you have to attach your financial statements You have to attach the signed version of the file of the return and move forward for submission. Let's summarize the steps for filing. Log into the website, go to the return, select the return what you want to submit. Just fill the information coming from your financial statement, map it to the line items, fill the additional details we are required, and you will receive. And just as soon as you submit, you will receive the confirmation of the notification that your return has been submitted. This notification will be received by you by email, by SMS, along with the invoices as well. Zakat will have a separate invoice number. Income tax will have a separate invoice number, because again, Zakat is a separate portion or the economic reality where the zakat money is going to the separate account and is being used for same purposes that are being guided by the Sharia for the zakat, and the income tax is moving for something for income tax is going to be moved to the government account to meet the financial objectives of the country. By this, I complete my segment, and I am bringing it back to say Faisal Zadi. Yes, Faisal.
Thank you, Naman. It was very insightful indeed. Uh, we will take now your questions. If you can please write the questions in the question answer box, so we can take it from there. So starting from the first question, do we need to add the GOSI payment in add back in CIT?
No, GOSI is an allowed expense.
GOSI is definitely an allowed expense. Yeah.
But just one thing that you need to consider, you should be having a reconciliation between your basic salary and the housing allowance appearing in your
Yeah.
financial records versus what is being appearing in the GOSI.
Yeah. Numan, I will
Thank
add
you.
one more thing here. Normally, maybe the person is asking about the CIT income tax where owner GOSI. The company owner GOSI is not claimable. May possible he is asking for this point.
Okay, sure. Thank you.
Thank you. If the expense is paid by ER both part, what does it mean? I'm not sure.
Which question?
I'm not sure.
Who is
If
the
the expense is paid by ER both part,
if
I'm
the
not
expense
sure.
is paid by ER both part, not it's not complete question from
Okay.
Dev Mehta.
Second
We can
question
go.
is okay. Please go on.
Yeah, ask him to rewrite because ER not
Yeah.
clear here.
Dev Mehta, can you please write the question again? Complete question. Next question, Malik Waqar Hussain. In Zakat filing, is it mandatory to mention COGS, inventory movement, opening plus purchases less return, or we simply add total COGS value?
It's mandatory to show the opening, movement, opening plus movement and closing. And also, it's
Yeah.
also beneficial to segregate local purchases or international purchases. Because if you not segregate the international and local purchases, there may be a penalty to hide international purchases can apply only for this. So there must show opening, purchases in both local and international, and then closing.
Does international purchases has any sort of tax credit or something, Siraj?
No, sometime because the number of companies receive penalties when they didn't show the international purchases. So in international purchases, what happening? They reverse back calculate that you are not showing your total purchases.
And
in
how
this
does
case.
it impact the local content thing?
Local
Like,
content,
for example, if we are producing 100% from the local content, so does it has any tax credit or any benefit in the tax return?
no, it's not. But the international purchases will decrease the point of local content.
Okay.
Just to add here again, local content is definitely a separate point of the topic apart from the text. But from the text perspective, why they want to have this movement available? Because your local purchases is something where they don't have the proper records available. But your international purchases is something where the customs record already available with authorities. They are going to match your international purchases reporting in your zakat return versus the purchases reported as part of your customs declaration. In case of plus or minus, you are going to be questioned. In some cases, the difference is going to be added as unallowed expenses in your zakat return. In some cases, it is going to be the deemed profit that is going to be applied based on the GP percentage of your financial statement.
Okay. Dev Mehta question was employee pays GOSI for the both part. When I think both part he means that the employee and employer himself themselves. So both are are allowed expenses or not?
Definitely, employee part is not the expense.
Employee part is not an expense. Great. Okay. So is it mandatory to file annual return of withholding tax if we are filing monthly withholding tax returns, and in case default? Okay, is there any penalty default? I think you meant. So is it mandatory to file annual return of withholding tax if we are filing monthly withholding
I
tax
think
return?
so. Adil is the best person to reply.
Sir, if we have filed a monthly withholding tax return, means in the whole year, if you have some withholding tax deduction and you have filed, then you have to file the annual withholding tax return as well. And there are
Okay,
related penalties also, but annual withholding tax is subject if you have any no,
credit available to your
those
part.
entities which
Mm.
have no monthly withholding tax, they are not required.
Right. Thank you. If the payment to the non, I think it's clear. If the payment to a non-resident on behalf of the owner, and this is a withdrawal. If the payment of the non-resident on behalf of the owner, and this is a withdrawal of the capital, not dividend. So the amount will be subjected to withholding tax or not? Anyone, if an investor withdraws capital from the company, not as a dividend, but a withdrawal of capital, would it be subjected to tax or not?
Sir, we have to check that it falls under this category. So this I believe it, Noman, you could also because they have mentioned payments to head offices, payment to associated companies, but this withdrawal I am not clear 100%
And
what it.
payment, what is the treat? What is the
Actually,
treatment? Okay, Naman,
uh,
please.
yeah, actually, I think he is talking about the capital reduction.
Yeah,
If
capital
if there
reduction.
if there's a proper capital reduction in the place where the legal formalities from the corporate law perspective has been complied with, where you can prove that it is not a dividend, it is corporate restructuring, a capital reduction, and is the face value of the capital that is being returned to the uh, to the to the owner, then in this case, yes, it is not subject to withholding tax, but this requires some deliberation because, especially in some cases where it's not a capital reduction, rather the liquidation sum in case the company is being liquidated and the owners are receiving the liquidation sum, there is some sort of deep dive required in terms of analyzing the transaction deeply.
Right. Yeah. Dave, I think we answered the question. Employee part has to be added back. Tahir Khan Saab question for for assets addition to calculate depreciation. You said 50% of the value taken from the past year and 50% from the current year for your zakat calculation. Did you say the same as explained above? If yes, Roman, if you can read it for yourself and
Yeah,
team.
so I think the question is right, but it was not for zakat, it is for income tax.
Okay.
So the fixed asset schedule in the income tax, yes, it is prepared in this way that the last year balance of the fixed asset register coming from the taxpayer zakat register plus 50% addition from the last year, 50% addition from the current year. But this only
Right.
applicable for the CIT.
So Haris is asking if we could not file the return, what would happen? So the owner company,
It's a
Adil,
zakat
right?
return,
it's a
not
zakat
income
return,
tax.
definitely.
There is a difference between zakat return and income tax. Noman can
Income.
answer it.
Yeah.
Income, yeah.
Mhm.
Noman answer it.
So again, in case it is a corporate income tax, then there's a penalty. If it is
Yes.
100% Saudi owned entity, which is only a zakat payer entity, again, conceptually, there is no penalty so far. There's a draft law already there published back in 2025, where uh, the feedback of the public has already been taken, yet to be become a law. If that become enforceable, then there will be a penalty as well on the zakat as well. The concept is this that since it is coming from the Sharia perspective, why there should be a penalty? Because Sharia does not impose a penalty if you are delaying the zakat. That is from where the dispute is coming in finalizing the law. But from the MR 1007 perspective, if you are not submitting your zakat return within 120 days of the end of your financial years, the statute of the limitation will be lapsed. And the same was
Right.
explained by Adil in his
Yeah.
presentation. It will move from
Mhm.
5 years to 10 years.
Okay. Okay. Do you need to file audit report along with the tax filing?
It's not mandatory. On the draft account basis, you can submit the account. But when you have a complete audit report, you have to resubmit to the authorities for this one.
At the time
So
of means at the time of submission, it's okay to file on a draft financials.
yeah,
But later on, you
basic
have to submit the final report.
final.
Correct. Got it. Got it.
Just to add here, in case of corporate income tax, the return has to be approved or has to be attested by the CPA as well.
Yeah. Yeah. Share of the profit from associate is charged to zakat against in the books of parent company. Share of profit from the associate charged to zakat against the books against in the books of parent company. Isn't it double charging from the group perspective?
Again, the investment is allowed to be deducted, so that allows you that eliminate the impact of the double counting of the taxation. It is only the the case which is still in discussion that what should be the right interpretation in case if you're going to have the zakat paying based on your adjusted net profit and not based on zakat base.
Okay, next question is for e-invoicing phase 2, is there any deadline for the entities to comply with this regulation or still waves are going on or waivers, I think you wanted to
So
write.
that for this e-invoicing, the general practice is that the ZK notifies you 6 months before. So these waves are going on, and now I think maybe said 28th or 24th wave. So, but for each taxpayer, they are notified 6 months before to fully make their invoicing solution compliant with the e-invoicing.
Great. There is another question. Which kind of companies pay income tax? That is, which is required threshold and nature of the business. I think this was also answered during the presentation. So Taha, when you get the presentation, in the group, you can find out from there, right, Adil?
Yes, it was covered by the. Yes.
Yeah, yeah. Okay, I think that's it. There is no other question, by the way.
There
The
was
presentation.
one question, sir. It was asked that if a GCC UAE based entity, but the owner is British, so what will be applied if he has some permanent establishment in Saudi? That the GCC entity, but the owner is 100% British. So I
Mhm.
believe because in this case the nationality is a very major factor, so it will be subject to CIT. But
Okay,
Numan bhai, can you further
Correct,
verify?
correct, correct.
Okay.
okay. That's great. Okay, that's it. Tax return and
If
zakat
there are
in
no
Excel.
question, I just want to highlight one thing.
Mhm.
The MR1007 has one amendment or has introduced one thing that was not previously there, which is the option of amending the zakat declaration. I think this is something because I was in discussion with one of the big four partner, and he explained to me that how some of his client get the benefit based on the zakat declaration amendment. Because sometimes,
Mhm.
especially for example, you as a financial controller joined the company and you found that previous returns were filed by someone else were and not following the right treatment that comes paying zakat or taxes or paying zakat higher than what it should be. Now you have an option. Again, there's a certain criteria or the checklist to be monitored. But yes, there is an option to go for amendment in the zakat declaration.
Uh, Damn great. There's another question. How old cases can be open from zakat authorities?
Statute of limitation, 5 years in normal
E-
cases, 10 years if you have not filed your zakat return in the time within the time frame.
Yeah, correct. There was another question. What are the, can you briefly explain what are the control transactions, Naman?
Adil, can you take this one?
Adil, you want to
Control
take,
transaction
just
basically
briefly, yes.
the related party transaction, and
Right.
for this related party, there's so much criteria. So the basic thing for TP is to identify what parties are related. So the transaction they are termed as control transactions.
All right. Another question was that 100 million threshold is on the total level or it is party level. If one party transaction exceeds 100 million, do we need to file for the other RP as well only, or the party who have the transaction exceeding the 100 million?
This
It's a
100
transfer
million,
pricing
I
related.
think, for this is for the whole related party, not for particular one
Yeah,
party. This is 100 million for the aggregate. But
aggregate.
one thing is very important, that this 100 million is for maintaining this master file, local file. But
Yeah.
for zakat, where if you have any related party transaction, I believe Noman Bhai will confirm that they have to file the DFCT and the affidavit. So for
And back,
this
yes, please.
DFCT, they have to file the control transaction form.
But and we can, I think we cannot also, we cannot file for a single counterparty or related party. Once we file the transfer pricing return, then we have to file for the whole company, right?
Correct.
Right. Okay. Okay. I think that's it. We don't have any more question, by the way. I would rather say thank you very much for the esteemed our panelist, Adil, Noman, Shiraz Saab. Thank you very much, by the way, the ICMA staff. I know it's late over there. It's post 12 p.m., 12 a.m., in fact, not p.m. So thank you very much for your support. And I hope all the participants would have like earned some knowledge out of it. And we believe it will be a continue. We would have the more session for the related to zakat and income tax, and this is first of its series. So inshallah, we'll see you in the next session. Anything, Siraj, you want to say, or Numan or Adil?
It's really nice to have with Adil and Noman. It's and love all the participant. They are with us from the 8 to 10 p.m. in KSA and in Pakistan till 12. I'm very thankful. Inshallah, in next month we are coming with VAT, detailed withholding tax and other tax related seminar. Inshallah, the team will be available next month as well as. Thank you, Adil
Thank
bhai,
you.
Noman bhai.
Thank
Thank
you.
you,
Thank
Siraj
you
bhai.
again.
Thank you, Siraj bhai.
Thank
Thank
you
you,
very much, sir.
Faisal, for giving this
Thank you.
opportunity.
Thank you. Thank you, Numan. Thank you, Dilbai. And thank you, ICMA staff, Hira, Salman, and everyone for your coordination. And Rida, uh, thank you. Thank you very much. Allah Hafiz.
Thank you very
Assalamu
much,
alaikum wa
everybody.
rahmatullahi wa barakatuh. Thank you, Hashim.
Walaikum assalam.